If you're familiar with ICT concepts, you may have seen the terms ERL, IRL circulating around Twitter and social media. So what exactly is that? First, we need to understand something very important. The market does two things: seeks liquidity or offers fair value. In other words, it draws to old highs and lows where you will find those large liquidity pools, or rebalance imbalances, also known as fair value gaps. And that's it. That's all it does. Yes, it can be that simple. ERL stands for external range liquidity. External range liquidity simply is a swing high or low. Now, why is that? Well, let's define the word external. It simply means belonging to or forming the outer structure of something. So, over here on the chart, as you can see, this is a swing high as it has a candle to the right that's lower and a candle to the left that's lower. That is how you identify swing highs. Swing low, candle lower to the left, candle higher to the right. That is a swing low. Now that we understand that, we can notice that they are in the external areas of price legs. Very simple, right? So IRL stands for internal range liquidity. Internal range liquidity simply is a fair value gap. Now, why is that? Again, let's define the word internal. Simply means belonging to or forming the inner structure of something, which is exactly what fair value gaps do, as they form the inner structure of a high probability price leg. A high probability price leg being a swing high to swing low that contains a fair value gap within it. As you can see, this is inside of this swing high to swing low. It is internal range liquidity. So how does the relationship between ERL and IRL work? Well, once ERL is traded to, we can expect a move back down towards IRL, meaning price is going to now seek fair value. Once IRL is reached, price has now offered fair value, also known as rebalancing an imbalance, and it will now seek liquidity at ERL once again. The market does this over and over again. This is why I'm always saying that swing highs and swing lows plus fair value gaps are all you need. This concept works on stocks, futures, commodities, crypto, and forex, and pretty much any market that can be traded. Now that you understand this, you will be able to forecast and know exactly where the market is likely to draw towards next, as well as knowing where we're going to move higher from, or lower, depending on the chart, of course. This is the key to it all, in my opinion. It's pretty much all I look for on the monthly, weekly, and daily charts. This is that higher time frame context that I must see before going into the lower time frames. No context means no trade. I am very strict about that. That is huge. That higher time frame context leads you to your lower time frame market maker models and ultimately to your entry. So again, having that context on the monthly, weekly, or daily chart is a must before I go any lower. So right here, you will find a very nice visual representation of everything we have discussed so far. If you look at the top left, you will see external range liquidity to internal range liquidity and what that would look like. So that is where you would find your lower time frame market maker sell models, with this right here being the sell side of the curve. You could look for shorts on a lower time frame to target this internal range liquidity. Over here, bottom left, is internal range liquidity to external range liquidity. It is where you will find your lower time frame market maker buy models. So on lower time frames, you can go here, look at the buy side of the curve, and look for long trade setups right there. On the top right, we have same exact thing, just flipped for the bear scenario. We have external range liquidity tagged, going now into internal range liquidity. In your lower time frames, you will find a market maker buy model there, and you could play longs up towards this IRL draw on liquidity. Looking at the bottom right, we will find internal to external range liquidity for a bearish scenario. On the lower time frames, you will find your market maker sell models there, and you can look for your short setups to play towards external range liquidity as the target and look for short trades within this sell side of that curve. So now, understanding all of that, let's dive into some examples. So here we are on the NASDAQ monthly chart. We have just taken external range liquidity in the form of that swing high right here. And we drew back into internal range liquidity in the form of a fair value gap, which is overlapping with this old swing high. If you didn't know, this is the reason why I marked out this one and why I expected higher prices off of this one as opposed to this monthly fair value gap alone, which does not have an overlapping PD array. Initially, the expectation would be that we can still see IRL to ERL from here, and that's totally fine. But if this monthly fair value gap were to fail, this monthly fair value gap with an overlapping array, which makes 2 PD arrays versus just one right here, can still send price higher, and we can still hold the expectation for bullish prices. So from here, I am looking for an IRL to ERL move. So let's move along forward in price and see what happens. So there is the IRL tag. So I'm just going to keep moving along in price to see how aggressively this candle decides to close above that external range liquidity high, because it is a very important factor to take into account if we do want to next come back into this monthly fair value gap that we see being created below. All right, so right here, we can observe that it was a very aggressive close above this swing high right there. Whereas if you look at this swing high and how this candle closed above, it wasn't that aggressive, right? Compare the two. It is very obvious how much stronger this close is compared to this one. All right, so that being said, this is a monthly chart. If we were to look at a weekly chart, for example, what we may see is a weekly fair value gap overlapping with this swing high. Also, on this monthly chart, what we have is an order block right above that fair value gap right here. So should price want to retrace, the level that should hold could be this order block to continue higher. It is that first line of defense within this swing low to swing high, within this current order flow leg. So the expectation would be we don't need to come all the way back down to this monthly fair value gap. We don't need to see an ERL, IRL here based on the factors I just laid out. The aggressive closed above this swing high, meaning we are running it versus sweeping it, and this order block right here, which is the first line of defense in this price leg. So now understanding that, let's dive into the weekly chart. So here we are on that weekly chart. I went back in time a little bit before we took that monthly ERL. So we took out this weekly external range liquidity in the form of this old swing high. We can see weekly fair value gaps right here and right here, and there's even one below that. So right now the expectation still is I want to see this fair value gap hold, as we do have this overlapping swing high right here, and I'm using the bodies because that is what's overlapping with the fair value gap, not these swing highs right here. So we have a nice area where we have 2 PD arrays we can continue on higher from, ultimately targeting this ERL right here, that previous week's high, and that monthly ERL. So I want to see a IRL to ERL move right there. So let's wait for price to come down into that, and then we could look for longs. So price comes down into that weekly fair value gap. We can now continue higher up towards external range liquidity. And there is external range liquidity currently being ran with an aggressive weekly candle. And let's see if that forms a fair value gap, which it does. So right here, we are running that high, meaning we are displacing aggressively above it. We are closing with strength. So now we have a weekly fair value gap here, which is what I mentioned earlier on that monthly chart, since we did see that aggressive monthly close above this high as well, which is the reason, again, we didn't want to see price come back into this monthly fair value gap that is lying around here. So right here, we have this weekly fair value gap overlapping with this old swing high. Again, that's 2 PD arrays compared to this one PD array right here, which is just a singular weekly fair value gap, which I believe will form right here. So just like we discussed on the monthly chart, we can still move higher off of this weekly fair value gap, but should that fail, we can come back down into this weekly fair value gap, which has this overlapping PD array in the form of that old swing high, and then continue moving higher off of that, giving us that IRL to ERL once more. This is the next expectation for price to continue moving higher off of that. So if this failed, we can still move down all the way potentially to the swing high to then continue higher. Whereas if you look at the way price closed above this old monthly swing high, and the reason we came back down all the way to this monthly fair value gap is the lack of displacement above that high, as can be seen by these rejection wicks right here. Whereas over here, we have strong aggressive displacement, which is why we don't need to return all the way back down to this monthly fair value gap. So let's continue on with this example here and watch how this IRL to ERL delivers. And there is that new fair value gap being created off of this old one, IRL to ERL delivered, and we now have a potential new weekly fair value gap being created. So let's mark that out. This could be the next IRL to ERL we see for a move higher. And we also have this old overlapping high right there. So there is your IRL tagged. Next expectation for price, your new draw on liquidity becomes this swing high. So this is your new IRL to ERL higher time frame context. And within this, you can find all your long trade setups. You can go into the 4-hour, which is what I would do, and look for a 4-hour fair value gap displacing higher. Use that as my PD array to then go into the lower time frames and look for long trade setups, as long as it is within a day that has news and within a kill zone. So for example, let's actually go down into the lower time frame here and see if we can find a trade opportunity. So we have this potential 4-hour fair value gap being formed right here, and there it is. So let's mark that out. And price is fractal, so same thing you see on the weekly, daily, monthly, that IRL to ERL applies to the 4-hour, the 1-hour, the 15-minute. It's fractal. So the expectation now here becomes IRL to ERL on this 4-hour chart. First target would be this 4-hour swing high, and then ultimately price going for that weekly external range liquidity right there. So within this, we can now look for our lower time frame entries. I do believe this was an NFP Friday. So on NFP Fridays, I expect large manipulation lower. So a move all the way down into this overlapping order block with fair value gap is not out of the question. And should we get that, I will look for 15-minute FVGs displacing higher and then enter there, targeting these highs. So let's dive into the 15-minute and see what we can find. So here we are, NFP is at 8:30. So let's see what happens on that news release. And as we see, we have a large manipulation down right to the level that is the order block overlapping with the 4-hour fair value gap. So at this point, I am looking for a 15-minute fair value gap displacing higher. So right here is that 15-minute fair value gap. So there is our entry. All I do is set my limit order to buy right at the low of that fair value gap. I'm going to put my stop loss at the body of this fair value gap candle, the expansion phase of that candle. The reason I'm putting it at this body is because I don't want to see price come all the way down and completely fill this fair value gap. Should price do that and move lower than that, I wouldn't expect this to continue on higher. I would actually expect this to now take out that low. I want to see this fair value gap get respected and ultimately not get filled again. So that is why my stop loss is at the body. Whereas again, the safest stop loss would be the swing low, but then my RR is quite skewed, meaning I'd have to take a much larger TP, which I don't want to do that. I like targeting the context highs. So what I do here is put my stop loss at this level because I do not believe we need to fill this entire fair value gap up. And I set my TP at a strict 2R, which is just above that 4-hour context high. So let's see how this delivers. So we get our entry and exit right there in one 15-minute candle. So I did take this trade, and I believe my last YouTube video was a top-down analysis on this. So I highly recommend watching that after this. But let's continue moving on. So moving back up to the 4-hour chart, we now have that trade idea completed. So let's see what else we can see. ideally we continue drawing up towards this external range high. So what we do form here is another 4-hour fair value gap that we can use to see higher prices out of. So we have a new IRL to ERL context right here, which it's okay to use this 4-hour IRL context because we are still within this weekly IRL to ERL. We do have that higher time frame context going for us, meaning we can use this 4-hour chart to frame a trade out of still. So this 4-hour fair value gap is still valid, and I would like to see IRL to ERL from there, meaning we can again go down into lower time frames and look for a trade entry right here. But since we're just focusing on IRL to ERL for now, let's just see how this delivers. Okay, so in this case, that was some atrocious delivery right there. But eventually we did see that external range high, and we never really broke this high probability leg, meaning from this swing low right here to this 4-hour swing high, which contains this 4-hour fair value gap, that is a high probability leg, for the reason being that it contains a fair value gap, and it is a short-term range between this intermediate term low to this intermediate term high, meaning these short-term ranges should hold until we reach that intermediate term high or that target. So it's nice to see that hold, but again, delivery was awful here, and a trade idea would have most likely resulted in a loss. All right, so this isn't a perfect concept, but I'm telling you right now, more times than not, this is going to work, and it is a very effective way of coming to a trade idea. So here is our next example. This is USDJPY daily chart. We have just swept external range liquidity right here. So I now want to see ERL to IRL in the form of this fair value gap. Now that we have hit IRL, I want to see IRL to ERL, targeting that swing high right there. And now that we have tagged ERL, I want to see ERL to IRL once more, going for this daily fair value gap. Now that we're in that daily fair value gap, I want to see IRL to ERL again. And you'll see this is a cycle, IRL to ERL, ERL to IRL. Now that we have taken that swing high, we are forming a fair value gap right here, overlapping with that order block. And we also have another fair value gap formed right above that. So just like those other examples we saw on NASDAQ, where you have one fair value gap and then you have another fair value gap below it, but the other one is overlapping with another PD array. If this one fails, the expectation is for price to still move higher off of that towards ERL. So let's see what happens right here. If you look to the left, we have just swept this swing high as well. So I want to see ERL to IRL. And as you can see, we are going for this lower fair value gap with the overlapping order block right there. So from here, I want to see IRL to ERL, ultimately targeting this swing high. And there it is. So we have just tagged ERL once more, and we have a daily fair value gap right below. So I want to see ERL to IRL and then IRL to ERL. So there's that daily fair value gap, and now targeting this daily swing high. And there we go. We also, I forgot to mention, we also have an overlapping order block right there as well. So let's move along with price here. And we can see another daily fair value gap being formed, which is also overlapping with this order block as well. So I want to see IRL to ERL right there. We now tag that daily fair value gap. I want to go for that daily ERL, that swing high. So we have just tagged that swing high, and as you can see, it repeats itself over and over again. IRL, ERL, ERL, IRL, IRL, ERL, ERL, IRL, IRL, ERL, ERL, IRL, IRL, ERL, okay? It is all the market does. So let's move on to our next example. Here we are on the Bitcoin yearly chart, and I just thought it was a very funny example because I don't really use the yearly chart at all in my charting or in my trading, but nonetheless, it is cool to see this concept play out on such a large scale. So here we have a yearly fair value gap overlapping with a yearly order block. So I want to see IRL to ERL targeting this yearly swing high. And there you have it. So here we are on the monthly chart of Bitcoin. This is that yearly fair value gap in order block. Right here, we have a monthly fair value gap formed. We have just taken this monthly swing high. That's external range liquidity. I now want to see ERL to IRL. And then once in that monthly gap, I want to see IRL to ERL. So now we have delivered over that external range liquidity, potentially forming a new fair value gap. So let's see how price develops here. So there is a new monthly fair value gap right there. We can use that as IRL to then target ERL via this previous month's high. So, and I want to see IRL to ERL. And I don't know if I mentioned it earlier, but we don't always have to take external range liquidity to then come down into IRL and see an IRL to ERL move. All right, so this is an example of that right here, but let's continue on. So at this point, we're not expanding higher, but we are still working within this monthly IRL. This right here is still the target. So as you can see, we are forming new monthly fair value gaps higher. This one is overlapping with an order block, and this one is just by itself. So let's see how price reacts at this swing high right here to potentially retrace. If we aggressively close above it, then it's likely we just continue pushing higher towards these highs. So right here, we actually had a very nice close that we could have potentially seen a move lower down into this monthly fair value gap. But we're going to dive down into the weekly chart right here to see what exactly happened there. So looking at this weekly chart, I can see quite a few examples. Again, this was that original monthly FVG that we used to move higher from, but you could also see it happen on a weekly chart right there. And you see another IRL to ERL right there. And you see one right here, which didn't exactly work out very smoothly, but that just goes to show that they don't always work, right? And nothing in trading is 100%. This will happen where we just mess around. Then again, this is crypto and Bitcoin, so this is quite characteristic of Bitcoin to have these long consolidations in a sort of stair-step manner where we expand, consolidate for a while, expand, consolidate for a while, and then expand, consolidate, expand. So this is very characteristic of Bitcoin actually. So something like this right here does not really surprise me. So right here, you can also see another example of IRL to ERL using this weekly fair value gap to target this weekly swing high right there. So that's the reason we didn't want to continue lower into this monthly fair value gap that, if you remember, we saw down below price right here. We had a very nice weekly fair value gap we could have continued moving on higher from, and ultimately we are now creating new fair value gaps above this swing high. So I don't want to see price move below that anymore. And let's see what happens here. If we form a nice weekly fair value gap we can use to continue higher, which we do, but we just don't retrace into it, and that will happen. They don't always come back into fair value gaps, and they don't always offer you that entry. So you just have to wait for the next one, and there will always be a next one. So right here, again, we never came down into this fair value gap, and we just went right to target. Let's actually go down into the daily chart and see if we could have found any sort of context there to potentially have played longs up into that high. So right here, this is that weekly swing high, if you remember, and we had a daily fair value gap right there, giving us IRL to ERL. So this could have been a nice area to look for longs. We also have this fair value gap on the daily chart right here that could give us that IRL to ERL. So we would expect price to aim for this external range liquidity in the form of this daily swing high and potentially continue expanding higher from there. So that wraps up this video, and I really hope you guys found that insightful. Thank you so much for staying until the end. I'm going to leave you with this final image as a summary of everything we went over today, and hopefully you have no more confusion on what IRL to ERL is, and you can try implementing that into your strategy, as I think it is pretty much all you need. Just a horizontal line and a gray rectangle, and you now know where the market is going to draw towards. Very simple. And also, if you have any questions remaining on this that you think I didn't get into, join my free Discord. I am in there every single day answering your questions and posting charts, outlooks, forecasts, trade reviews, you name it. So you're missing out on some free value if you're not in it yet. You can find the link below. And finally, Apex is hosting an 80% off sale. They are my #1 preferred prop firm, so you can use code PICKLE. So again, thank you guys so much, and until then.